Hello, everyone. Hope you guys are fine. Okay, we'll carry on. We started our class now. The time now is 5:30. All right, so today we are covering trading stock in week number 9. So we'll cover the definitions of the trading stock. Then that's actually covered in section 1 of Income Tax Act. Then there are amounts to be taken into account in respect of values of trading stock. That's taken into account section 22 and other in the listed below sections. So we'll also deal with reduction of cost of certain assets and shares held as trading stock. So the trading stock is actually defined. The definition of trading stock includes anything produced, manufactured, constructed, assembled, purchased, or in any other manner acquired by a taxpayer for the period of manufacture, sale, or exchange by the taxpayer on behalf of the taxpayer. It actually includes anything the proceeds from the disposal of which forms or will form part of the taxpayer's gross income, otherwise than in terms of paragraph J, so other than mining, recruitment, or paragraph A or section M, which is insurance proceeds or the definition of gross income. So in terms of paragraph 14 of the first schedule, the sale of plantation also as a recovery or recoupment contemplated in section 8.4, which is included in gross income in terms of paragraph N of the definition of gross income. So also any consumable stores and spare parts acquired by the taxpayer to be used or consumed in the course of taxpayer's trade. But trading stock definition actually excludes foreign currency option contracts of what exchange contract is defined in section 24I. So the income tax acts tell us, how trading stock held and not disposed at the end of the year of assessment should be dealt with in determining the taxable income. Section 21, in fact, Roman figure 2 state that the amount of trading stock must be taken into account in determining the taxable income by including such amount in the gross income. So it does not direct how the stock should be dealt with in the next succeeding year of assessment. However, our courts have determined that in determining taxable income, the law requires that the movement in the value of trading stock should be recorded. So this means that the value of the previous year's closing must be deducted from the value of the current year's closing stock. That's the CIR versus Richards Bay case. So if we look at the basis applied used for determination of the taxable income, we see that trading stock is treated on the same basis as that is used for financial accounting to determine the cost of sales. So we've got the opening, then you've got purchases, which is deducted. So you've got your opening stock, section 22. Then you've got your purchases, which is actually dealt with in section 11A. Then you've got your closing stock is dealt with section 22 as well. But it's actually, done the same, treated the same with accounting. Valuation. So what value of trading stock should you take into account? So the value of trading stock held and not disposed at the end of the year of assessment, according to section 22(1)A, so the cost price, so the cost. So such amount as the commissioner may deem reasonable as representing the amount by which the value of the trading stock, other than a financial instrument, has been diminished by reason of damage. Remember, there may be damages, there may be deteriorations, there may be change of fashion, decrease in the market value, or for any other reason satisfactory to the commissioner. So the value actually will be highly determined by the commissioner. So trading stock, so we've got the cost price, or according to section 22(3), so they say the cost incurred in acquiring such trading stock, plus further costs incurred in terms of IFRS in getting the stock to its then existing conditions and locations. So all the costs incurred to actually put the trading stock into condition or the manner intended by management. So the cost price of trading stock, then the purchase price, therefore, input duties, are the taxes that are not recoverable, transport and handling costs are reduced by trade discounts. Then for a company, the further cost must be in accordance with IFRS. Then which is IS2, which did inventories. Then section 23C, capital C, the cost excludes VAT incurred by a person who is a vendor. But the trading stock acquired for no consideration, then section 22.4 will apply. So it's for the deemed to be acquired at market value at the date of acquisition. But you should note that this applies where the trading stock is held and not disposed of at the end of the year. Section 24 to section 22.4 then does not permit a deduction for a deemed cost. This is governed by section 11A and requires expenditure. So there's this case. So in this case, it was actually, determined that. Oh, sorry about this slide. I think there's some things here. So in this case, this is where we find that I think this deals with farming. I don't know about it. Let's just carry on and come back to it later. All right, let's go through this other. So diminishing in the value. So the taxpayer must be able to demonstrate that there has been a diminution in the value of trading stock in case there was diminution. So the cause of diminution also must be set out. As per section 22.1. So then the SCA has explained the position in the case of SARS versus Volkswagen South Africa. Then explained that the position that SARS may only grant a just and reasonable allowance in respect of diminution in value of trading stock. Trading stock under section 22.1 in two circumstances. So the first of all, the first is where some event has occurred in the tax year in question, causing the value of the trading stock to diminish. Secondly, this is where it is known with reasonable certainty that an event will occur in the following tax year. Both scenarios then are consistent with the basis of promotion that assessment of income tax rate to event that have already occurred rather than event that may occur in the future, but not the same as difference. Can you still hear me? All right. I think you can still hear me. So, because that in this case, therefore, the court made it clear that applying pure accounting principles to the value stock by taking account of expenditure to conclude a sale is not contemplated in the concept of diminution. Also, the process of valuing stock may be undertaken in respect of individual assets or classes of assets. So section 22.1 then, 22.1a, Roman figure to state that in determining any diminution in the value of trading stock, no account must be taken of some items of trading stock held and not disposed of by the taxpayer may exceed their cost price. That should never be taken into account. Then in another case, they actually stated that in which the court found that it is not acceptable to reduce the value of trading stock for tax purposes by applying a percentage based on the aging of the trading stock. So I guess there were some taxpayers who were taking advantage, then they were actually applying the aging. That's not allowed according to SARS. Opening stock. How about opening stock? Section 22.2a. The value of trading stock held and not disposed of at the commencement of the assessment shall be an amount equal to the value of trading stock taken into account in determining taxable income at the end of the immediately preceding year of assessment, just last year. Section 22.2b then state that if the taxpayer did not have the trading stock at the end of immediately preceding year of assessment, the amount to be taken into account is the cost of the taxpayer of such trading stock. Section 22 to be then includes the trading stock acquired for no consideration. It should also be included on the first day of the year of assessment. Then evaluation under section 22.4 then will apply. So in the case of Eveready, so they actually confirm that the principle that stock acquired for no consideration on the first day of the year of assessment is deemed to be acquired at the deemed cost determined under section 22.4. Then amounts held as capital assets or personal use assets that become trading stock on the first day of the year of assessment, then the valuation under section 22.3A2, then linking to paragraph 22, paragraph 12.2c of the H schedule must apply. Section 22.6. So when the period of assessment is less than a full year, what happens in that case? The closing stock must be calculated at the end of the period, and the opening stock must be accounted for at the beginning of the period, even if it's less than 6 months. So we've got how actually everything gets calculated. So you'll have your sales, then you'll have your opening stock, which will be deduction. Then you have your purchases for the year will be deduction. Then you've got your closing stock, which should be added back before you arrive to taxable income. So section 23F1 deals with trading stock not held or not disposed, which the goods have been stripped, but the sale is not yet conditional. So it is not included in the income. So the taxpayer is denied the section 11A deduction in that year and is only allowed to deduct the cost of the trading stock when the disposal actually occurs. The value fails to be included. The value fails to be included as trading stock at the end of a later year of assessment. Then the trading stock is lost or destroyed, or the contract for its acquisition is terminated, in which case a deduction will be allowed only for expenditure actually incurred. Section 22.8 then deals with deemed recoupments. The trading stock for which a deduction has been allowed is not sold in ordinary course of business, but is instead sometimes applied for the taxpayer's personal use or consumption, sometimes disposed by way of donations, may be disposed for of less than market value, or distributed to a shareholder in specie, then applied for any other purpose apart from disposal in ordinary course of business or no longer held as trading stock. Then in that case will apply recoupment. In the recoupment, this is where the trading stock for which a deduction has been allowed is not sold in the ordinary course of business, but is instead applied for the taxpayer's personal use or consumption. The taxpayer is deemed to have recovered or recouped an amount equal to the cost of such trading. So that should be recouped and be added back, in fact, to on their gross income. So the trading stock for which a deduction has been allowed is not sold in the ordinary course of business, but is instead disposed under a donation, not qualifying for section 18 capital A deduction, is disposed of for less than market value, is distributed to a shareholder in specie, applied for any other purpose apart from disposal in the ordinary course of business, or no longer held as trading stock, then the taxpayer is deemed to have recovered or recouped an amount equal to the market value and the date of that event. So will be added back to their gross income on calculation of their taxable income. So section 28C then deals with deemed recoupment as well. So they say trading stock for which a deduction has been allowed is not sold in ordinary course of business, but is instead disposed under a donation, qualifying in this case. Remember last time it was not qualifying, then the taxpayer is deemed to have recovered or recouped an amount equal to the amount taken into account in respect of that stock in the year of assessment under section 22 or section 11A. There are three examined provisos that you should be aware of: consumption or using carrying on as a trade, disposal for less than the market value, disposal where the proceeds are included in the gross income under paragraph J capital A for the definition of gross income. You need to know those provisos. Then provision 1, consumption or use in carrying on the trade. So this applies where the consumable stores are consumed or spare parts are used, but there was a deduction of Section 11A, then there should immediately be a recoupment. Provisos. Provisos B, trading stock is disposed of less than the market value, so the recoupment must be reduced by the amount of consideration received or accrued. So we'll have a recoupment, but it will be reduced by proceeds. So provisions T, so the asset disposed of is an asset in respect of which the proceeds on the disposal are included in gross income under paragraph JA of the gross income. Then this ensures that an amount received from the sale of these assets is included in gross income, even if they were used as capital assets. So the trading stock should look for trading stock definition. So JA asset remains a trading stock since proceeds always included in gross income anyway. So they remain the trading stock, even though they are capital assets. So in the change in use, sometimes the trading stock becomes a capital asset. So there should be a link between paragraph 12 of the H schedule. Then if that's a link, then because you can see this is a change in use where the trading stock may become a capital assets. Maybe capital assets also can become a trading stock. So that's a change in use. So when share dealers, then we've got shares as trading, now we've got shares as trading stock. So a person operates as a share dealer when that person acquires shares with the intention of reselling them at a profit. So the person may trade in shares as business, or the shares may have been acquired in one of speculation. Speculation is just because you want to make sure that when the price increases, you sell them off. So in either case, there is a scheme of producing the shares as trading stock. Then so dispute may arise with SARS, of course, as to whether the proceeds on the disposal of shares are revenue or capital in nature. So Treasury has therefore included Section 9, capital C in the Income Tax Act to provide safe harbor provisions which give shares the character of capital in prescribed circumstances, even where they may have been acquired as trading stock and are still held. So let's just read about that. So in this case, you need to ignore corrected persons since related to Section 9C of that are excluded by PC. So in that case, I think also in your case in ACA, so you don't have to worry about that. But disposal in paragraph 11, so in deemed disposal, it's actually dealt with Section 9, capital H, and also Section 9, capital H, and paragraphs also need to ignore that. Paragraph 12, 2B, non-resident remove a share from permanent establishment South Africa. Also, you do have to ignore that. Also, commences to hold shares is trading stock. But now let's talk about equity share. What is equity share according to Section 9C? So definition of equity share is found in Section 9, capital C1, and must be read in conjunction with the definition in Section 1. So interpretation note number 43 that states that definition of equity share is in Section 9 expands the definition of the same term in Section 1 to include a participatory interest in a portfolio of collective investment scheme in securities and portfolio of a hedge fund collective investment. So equity share then excludes foreign companies that are not listed on the Johannesburg Stock Exchange. Example of foreign companies listed on the JSE, includes Anglo. So we've got companies that enjoy dual listing, meaning which they are listed in South Africa and other countries as well. So equity share then, Section 1, means a share in a company, and unrestricted shares, then excludes a non-participatory preference shares. Then we've got shares, which includes a member's interest in a closed corporation, excludes an option to acquire a share. That's not necessarily a share. Excludes also for a convertible debenture. So company may include a corporation as well, a CC. But remember, there are no more CCs that can be registered in South Africa. It's not happening anymore. However, you can buy the existing
Hi, Thembisile, are you there?
Yes, I'm here. I think it's just sharing me.
Yeah, because I lost him as well. But I guess you can take over. You can carry on from where you left.
I don't even know anything.
So what do we do? We wait for him or what?
I'm not sure what we must do. I think we must wait for him.
Okay, now go.
No, I'm sorry, guys, about that. I think it's network. Unfortunately, no. With the load shedding and everything, experience network issues.
No, understood, sir.
All right, thank you very much. Let's try to carry on. Oh, there. Is it still recording?
Yeah, it's still recording.
All right, thank you very much. So we're still dealing with section 9C, so actually in summary. So we're saying equity shares includes shares enlisted and unlisted in South Africa, including members' interest in a close corporation, and the shares of foreign companies also listed on the JSE. So section 9C, capital C2, then we talk about shares that has been held for at least 3 years. So any amount received or accrued other than a dividend or foreign dividend or any expenditure incurred in respect of an equity share must be deemed to be a capital nature. If that equity share had at the time of receipt or accrual of that amount or incur a lot incur of expenditure of that expenditure being held for a period of at least 3 years. So even if the intention was to have the shares, maybe the shares were actually held for what is this now for resale in the future. However, if they've been held more than 3 years, the assumption is that any amount that you receive will not be included in gross income. So interpretation note number 43 then clarifies the uncertainty as to classification of shares held for at least 3 years. So I've got normal rules used for shares held for less than 3 years. Facts and circumstances also case law will apply. Section 9C then carries on and states that when this section applies, any subsequent disposal must be subject to CGT. So meaning which the best thing about this though is that it's not that all the amount will be included in gross income immediately. However, CGT will apply. So an expenditure will no longer qualify for deduction under Section 11A since of a capital nature. However, an interest expenditure may not be deductible if not in the production of income. Section 23 is very specific about that. Then the 3-year period measured from the acquisition date of the shares. Then the recoupment is the expenditure deducted under the Section 11A for the cost of the share and other costs, or the amount included in the opening stock. So the recoupment remains unaffected even if the share is sold at capital loss. So you should have the recoupment anyway in these shares, because right now they are changing from being a trading stock to be an asset. Section 9C, then regardless of the specific shares that are transferred in a disposal, where shares have been acquired in tranches. So the shares are deemed to have been disposed in the first in, first out basis, very important. Even though the shares cease to be regarded as trading stock, Section 9C7 then provide that Section 22A does not apply when a share has been held for a period of 3 years. So there won't be recoupment. So Section 9C8 then states that if shares are subdivided, consolidated, or converted, the new shares will be deemed to be held from the original date of acquisition of the old shares, not necessarily on the date of consolidation. Then the right of the shareholder are substantially unaltered, and no consideration passes directly or indirectly from one holder to another company in respect of the transaction. So that should be taken into account. In the year, so now we begin to speak about share dealers. Remember, we're talking about share dealers here. It's either they buy shares to resell them, or they buy shares, then they keep them for more than 3 years. So in the year that a share is acquired by a share dealer, on occasional speculator, so the deduction for the cost of shares is under Section 11A, because you don't necessarily know whether the shares will, over time, and they will be kept more than 3 years. The cost of the shares will include the acquisition cost, commission paid to brokers, registration cost, and securities transfer tax. So this applies to transfer of all shares. So section 2 then they indicate that they should actually provide, I mean, the taxable amount of these amounts. So you should not really worry about, I mean, like really determining. Maybe they might tell you there's acquisition cost, they are associated, but they should really under normal circumstances be provided. I mean, so as ACA is what they should do that. So if not sold at the end of the year, included in closing stock, of course, even if it's share dealer, then they include the opening amount following in the following year. Shares dealers are also able to deduct the following under this section. So bank charges, internet access charges, strip custody fees, cost of telephone calls. But remember, they're operating a business themselves, so they're allowed to deduct this amount under section 11A. But share dealers would also be able to deduct the interest on loan used to buy shares under section 24J. Shares held for at least 3 years. So HC applies regardless whether the vesting takes place after 3 years. So section HC applies when a share vests in an employee. Vesting may occur after the employee has become the owner of the share. So section HC1 treats the vacate on the vesting as revenue, notwithstanding if 9C would apply. 9C, remember, to speak about 3 years. So the holding period under section 9C does not necessarily. Please mute yourselves, guys. So the period commences from the date that the employee becomes the owner of the shares. Section 8C applies. Okay. So we're still talking about section 8C. So we said applies regardless of the vesting takes place after the year. So section 8C, of course, applies when the share vesting to employee. But vesting, of course, may occur after the employee has become the owner of the share. Then section 8C, I mean, treats the gain on the vest, because remember the shares when they vest the employee, they might be the gain. So, but remember the section 9 where the shares have been held, I mean, for more than 3 years or something, the holding period and section does not necessarily commence only on the vesting. So this period commences from the date that the employee becomes the owner of the shares. You see, okay, no, that's fine, man. Thank you very much. I think anyway, guys, thank you very much. This takes us to the end of today's session. It was just trading stock, not so much, I mean, of the topic. I mean, not a lot is covered though, but I mean, it's not a bigger topic. So someone was said, oh, I just love taxes. Said no one ever. That's all, guys. Thanks very much. I'm sure, and I believe you guys are preparing for the second test. Are you?
Yes, sir. Yes, sir.
Yes, yes. Thanks very much, guys. And do you know the date? And the date is actually on the, I mean, it's actually on the learner guide. So please remember for the second test. If you feel like you must consult, you should come for consultation. I will try to see if there is a prior, I mean, last year's test, then I can share with you guys so that in case you want to practice and all that. As for the tutor, I'm still waiting also. I will update you, of course, when I hear something, I mean, some information.
Much appreciated, sir.
All right, guys, thanks very much then. Thanks for attending.
Thank you.
Enjoy.
Thank you.
Bye.
You too. Bye.
Thanks, sir.
Thanks.
Thanks, sir.